So we have the year fraction between March 20th, 2020 and the end of 2021, December 31st, of approximately 1.78. And then going forward, we have a full year beginning year. So now we can now bring in the EBITDA excluding stock-based compensation. So in this case, let us go to financial analysis, our financial statements, and let us grab EBITDA excluding stock-based compensation, since we believe that Amazon has there's a significant amount embedded in stock-based compensation, so we want to include that in our DCF calculations. So in this case, we will grab EBITDA excluding stock-based compensation for the fiscal year 2021 going forward. So we can grab that and fill this to the end of the projected period. We can also go the free cash flow, switch back to the financial statements. And let's grab here the free cash flow to the firm from fiscal year 2021 to the end of the projected period. So let us grab here. Let's fill the right with Control R. So having that set up, we can now use that to determine our terminal value exit multiple, perpetual growth, and a hybrid of both. So in this case, we will set that up to be the end of year cash flows here. So we believe that, like we said before, if you hold stocks in Amazon and you plan on selling the stocks by the end of the year 2031, or if in case Amazon was going to sell this company by the end of year, then we will estimate the terminal value based on that, and meaning that the cash flows will not grow past 2031, or you're not expecting to own shares past this terminal period. Also for the purpose of growth, meaning that you want to hold your stocks forever. So you believe that you're going to be holding your stocks forever, or this company's net earnings will grow forever. Then in this case, we'll use the golden growth model to determine your terminal value based on that methodology. So let us begin here with the exit multiple. So with the exit multiple, it's going to be equal to we'll have to switch to our control panel tab. We set terminal value EBITDA multiple of 25 times. So in case you want to sell your stocks at the end of that terminal period, you're going to be selling that at 25 times, and then we multiply that by, switch back to our DCF tab, by EBITDA excluding stock-based compensation by the end of this fiscal year 2031. So we have that terminal value calculated there. So in this case, essentially what we are saying here is that this is the enterprise value of the business based on the terminal value exit multiple. And then for the perpetual growth, we use the golden growth model formula. In this case, it's going to be equal to, we take in brackets, the free cash flow to the end, to the firm at the end of the terminal period. And then multiply that by 1 plus our long-term growth. So we already named that cell in Excel as underscore long-term growth close that and then we divide that by the weighted average cost of capital, which we calculated a while ago in our work part. So we have the weighted average cost of capital, that is the discount rate. So this is gonna be underscore work. We have that set up there, and then minus, in this case, our long-term growth. So the work minus underscore long-term growth. We can close that. We make sure that we have this also in brackets, so we can close everything up. This way we will determine the terminal value based on the codon growth model, in this case our perpetuity growth. So these cash flows will be growing in perpetuity, as we said. So we have the long-term growth, like we said before, it's a very significant variable to consider. So essentially what we are saying here is that it could be used, we can use the cost of equity method to determine the long-term growth, and also we can use the cost of equity method based on dividends, if this Amazon paid dividends, or we can also use the net income calculations in determining the long-term growth. So it's very important for us to understand